Experts are saying that traditional retirement planning is not as reliable as it used to be, and investors may need to rethink how to save for the future.
Yeah, that's right. For years, the formula was to put 60% of a portfolio in stocks, 40% in bonds. But conventional wisdom, like so many subjects, seems to be out the window because on average, most people lost 15% of their investments this year. For more on this, let's bring in Akane Otani. She is a markets reporter for the Wall Street Journal, and her most recent article covers the investment strategy. So, conventional wisdom, we're supposed to diversify our portfolio. That's still important, but it's really designed to offset the risk of losses, and that didn't work this year. So there's some obvious reasons why that's the case, but explain for our viewers what your thinking is on all of this.
Yeah, so traditionally, investors with a mix of money in the stock market and the bond market tend to get pretty good returns over the long haul because generally the thinking is when stocks go up, sometimes bonds go down. And generally when stocks go down, bonds go up. So even if the stock market is having a really bad year, like it is this year, usually the bond market offers some sort of relief. But this year, that trade has completely fallen apart. We're actually on track for the worst returns for a 60-40 portfolio since 1937. That's how bad it is. So, you know, even in the dot-com bubble bursting around 2000, 2008, the financial crisis, COVID, so many of the sort of past downturns and crises we've been through, this portfolio really got investors through. But this year, for a variety of reasons, it really has not worked.
I mean, for those of us who hopefully are many, many years away from retirement, you know, the approach is different. Do you think it's still sound advice to just wait the losses in the hopes that the market will, I guess, inevitably rise at some point? What do you advise for people who are, you know, close or further away from their retirement?
Yeah, that's absolutely the advice that we've been hearing from financial advisors. I mean, you always hear, don't do anything rash. Don't pull all your money out of the markets, even though it feels like that's the right thing to do, because you've seen in the past how that can really backfire. What happens is eventually the market bottoms out, and then you've missed your chance to sort of get back into the market. And, you know, you've seen in the past, like after the financial crisis, 2008, a lot of people actually very burned by the fact that they got out of the markets and then they waited and waited and waited, and stocks kept going up and up and up, and they actually missed out on a huge portion of returns that they could have gotten if they just stayed in the market. So for people with a longer term horizon, I think the advice generally stays the same, even in a year like this year, which is to not do anything too crazy and not try to shift a lot of your money from one part of the markets to another, because it just usually tends to backfire.
Definitely don't use it and then buy a bunch of crypto. Not now.
You know, don't even check it right now. If you're far away from retiring, don't even check it. Your mental health will benefit from it. But Akane, obviously, as Lilia said, it's different though for somebody who's younger versus retirees. Should they be thinking about diversifying their portfolios even further with assets other than stocks or bonds? What do you think about real estate, especially as that market is changing so much?
One of the, I think, most popular areas that we've been hearing advisors talk about is commodities, actually, because if you think about it, one of the big reasons why markets have been doing so poorly this year is because of inflation. It's been a lot hotter than people thought it would be. It's been a lot more persistent. And commodities are actually an area where you can actually sort of benefit if inflation continues to run very hot over the next few years. You're thinking about things like oil prices being high, funds of shares of companies that are in the oil production world. Those types of things will generally be doing well if inflation continues to run hot and can sort of offer a little bit of protection. And then, of course, everyone's favorite, cash. You know, in times like these, especially when things feel a little bit of uncertain, some investors are probably going to want to feel a little bit more comfortable. And one way they can do that, of course, is putting money into cash accounts that are actually earning more in interest now than they were for the last several years.
Oh, savings. You know, you don't usually think about putting money as a long-term investment strategy into a savings account. But with interest rates rising,
it might be a good time to do it.
All right.
Akane Otani, thank you for the wisdom.
Thanks for having me.